You guys, did you know that at one point Plug Power was trading for over $1,500 per share? That's nuts. After the $15 IPO in late 1999, massive hype about the potential of hydrogen fuel cell technology, as well as the dot-com bubble, caused share prices to quickly soar, reaching an all-time high of $1,565 on January 24, 2000. Unfortunately, that marked a turning point, as Plug Power soon after began its massive descent, which culminated in shares bottoming out at just 12 cents in February 25th of 2013. I can't help but laugh, that is ridiculous. This stock is wild. If you want to get involved here, strap in for one heck of a roller coaster. Currently, Plug Power is on the rebound, trading over $5 a share. On this episode, we're going to discuss what's going on at Plug Power, and then I'll give my opinion on the stock from a long-term investor's perspective. Hi, I'm Gio, and welcome to Renewable Energy Investments. This channel offers a high-level discussion of publicly traded renewable energy companies, because building an investment portfolio starts with building awareness. Okay, but first, a little background on the company, for color. Plug Power is a leading provider of hydrogen engines and fueling solutions enabling e-mobility. The bulk of the company's revenues come from selling hydrogen fuel cell powered forklifts to warehouses. Its customers include retail heavyweights like Amazon and Walmart. Home Depot is rumored to have become Plug's third largest customer. Other big-name customers include Kroger, Lowe's, and Procter & Gamble. The CEO, Andy Marsh, has been championing a future with a more diversified revenue pool. The company really wants to break into the heavy-duty mobile market by selling fuel cell-powered trucks and delivery vans. For example, last year, Plug started a pilot program in which electric FedEx trucks delivered packages in the Albany area, and they were outfitted with hydrogen fuel cells. Plug also ran a pilot program with FedEx to power FedEx airport ground equipment trucks at airports in Albany and Memphis. During the first quarter, the company launched its ProGen hydrogen engine for heavy-duty applications, including Class 6, 7, and 8 trucks, transit buses, various port applications, and large-scale data centers. Plug already supplies hydrogen fuel cell-powered engines for global delivery giant DHL. It secured a deal to supply 100 trucks for DHL with fuel cells. It quotes DHL's head of DHL Express operations in Germany as saying, "If everything works as we imagine it would, there could soon be 500 vehicles worldwide." The company is increasing its presence and partnerships in Europe, where more countries are emphasizing renewable energies over fossil fuels in the wake of the Paris Accord. Plug has now become the largest buyer of liquid hydrogen in the world and has developed a relatively strong hydrogen infrastructure with over 80 hydrogen stations deployed. The company is exploring various initiatives which could turn hydrogen into a sustainable recurring cash-generating business. Quick break to remind you to hit that thumbs up button to help support this channel. It really means a lot to me. Also, I invite you to subscribe to this channel to follow along in our discussion of renewable energy companies in future episodes. Alright, back to it. Hydrogen fuel cell benefits. Hydrogen fuel cells can double the range of battery electric vehicles and provide twice the fuel efficiency of diesel engines. Fuel cells are lighter and take up less space than batteries, meaning more space and weight can be allocated to cargo. Refueling can be accomplished in a matter of minutes, as opposed to the long charging time needed for batteries. This is a big deal for customers who run their warehouses with multi-shift operations without sufficient downtime for charging batteries. Hydrogen is on a declining cost curve. In fact, according to Bloomberg New Energy Finance, the cost of green hydrogen produced using electrolyzers is expected to decline by over 50% by 2030 and be cheaper than SMR-based hydrogen. Levelized cost of hydrogen will likely follow a cost reduction trajectory of renewable energy. Disadvantages of fuel cells. Hydrogen is a very dense source of fuel, making it extremely flammable and difficult to store and transport. Because hydrogen is not naturally occurring, traditional energy, like natural gas, renewables, or fossil fuels, is required to produce it. There is high energy waste in converting traditional energy into hydrogen, and even further energy loss in cooling the hydrogen down to a liquid state, or putting it into tanks under high pressure so that it can be used as fuel. Even more energy is required to deliver the hydrogen to fueling stations. As a result, the cost of hydrogen fuel is almost twice as expensive as gasoline and 3 to 4 times as expensive as electricity drawn from the grid. The biggest hurdle of all is the lack of infrastructure to distribute hydrogen to customers. Currently, only a handful of hydrogen filling stations exist in the United States, mostly in California. Essentially, critics of hydrogen fuel cells take the stance that it represents a viable technology in that it works. But it does not create a viable business opportunity because hydrogen doesn't work efficiently, at least not at this point in time. Oh, and there's always the fact that Tesla CEO Elon Musk has argued that fuel cells efforts are mind-bogglingly stupid. Although I personally wouldn't bet against Elon Musk, who has a deep and intimate knowledge of electric vehicles, I would also note that Elon may be a bit biased, because fuel cells could end up being battery electric vehicles' main competition. Take a look at this excerpt from the most recent annual report. Management acknowledges these challenges. If we are unable to successfully develop future products that are competitive with competing technologies in terms of price, reliability, and longevity, customers may not buy our products. Technological advances in alternative energy products, battery systems, or other fuel cell technologies may make our products less attractive or render them obsolete. Impressive deals mean major volatility. Plug's most recent decade was defined by impressive major deals with huge name partners, followed by disappointing financial results from those deals. For instance, in February of 2014, Plug signed a partnership deal with Walmart to supply fuel cells for its forklift fleets. After initially popping on the news, Plug's shares tanked when it became clear that the Walmart deal would not be enough to make Plug a profitable company. Prior to the Walmart deal, in early 2013, Plug shares had dropped to their lowest point of the decade, falling as low as 11.5 cents. Over the next year or so, the Walmart deal would drive nearly a 1,000% gain in the stock, which reached $11.72 on the Walmart news. Plug shares again rallied in 2017 when Plug announced a new $600 million deal with Amazon to supply forklift fuel cells and essentially double Plug's revenue. The 2017 Amazon deal only got the stock as high as $3.21 before it once again drifted down to the $1 level by the beginning of 2019. In the end, over the past 15 years, Plug stock has given shareholders an average annual return of an awful negative 15%. Plans for future growth. Proponents of Plug Power will point to the company's 5-year forecast as one of the most compelling reasons to buy the stock. The forecast estimates that in 2024, Plug will generate $1 billion in revenue, over a fourfold increase from the $230 million it generated on the top line in 2019. This revenue acceleration is set to come from continued growth from its anchor customers and the addition of one new multi-site customer on an annual basis, coupled with the expansion in Europe. By 2024, the company expects to generate $200 million of annual revenue from the on-road electric vehicle market and $50 million of revenue from stationary applications. According to management, operating expenses will decline from 30% of revenue in 2019 to 10% of revenue by 2024, helping the company to generate operating income of $170 million. In 2024, management forecasts the company will recognize adjusted EBITDA of $200 million. Upcoming acquisitions. Plug Power is working on accomplishing its hydrogen vertical integration strategy, designed to push down hydrogen fuel cell costs while turning sales of hydrogen fuel into a cash-generating business. The company expects its hydrogen demand to increase fourfold to over 85 tons of hydrogen per day by 2024, up from over 27 tons a day today. To accomplish this goal, Plug is pursuing 2 transactions. The first would be the acquisition of United Hydrogen Group, Inc., a company that provides liquid hydrogen to industrial customers throughout the United States. The second is an acquisition of an electrolyzer technology platform company. An electrolyzer is a device that uses an electric current to turn water into hydrogen and oxygen. These technologies are said to potentially allow Plug Power to expand its addressable market opportunity into other industrial applications. Plug Power has not yet entered into a definitive purchase agreement with either of the acquisition targets. A history of broken promises, debt, and dilution. Many investors simply don't trust management's guidance at all, and honestly, given Plug Power's history, I don't blame them. For instance, in 2012, with respect to orders, management stated, "We see significant pickup with our present customer base and are forecasting annual orders to range as expected between $50 million and $60 million. The actual results of revenues for that year was $26 million. Here's another one. And another. Oh, and here's a few more. You get the point. Management has a long-established track record of overpromising and under-delivering when it comes to revenues, cash flows, and profitability forecasts. This calls management's current guidance for $1 billion of bookings by 2024 into question. Bears also point to the company's inability to generate profits and positive cash flow as a big red flag. The company has to rely on issuing debt and equity to keep its operations up and running. Per the annual report, we have incurred losses and anticipate continuing to incur losses. We have not achieved operating profitability in any quarter since our formation, and we will continue to incur net losses until we can produce sufficient revenue to cover our costs. We cannot guarantee when we will operate profitably, if ever. The profitability of our products depends largely on material and manufacturing costs and the market price of hydrogen. The hydrogen infrastructure that is needed to support our growth readiness and cost efficiency must be available and cost efficient. To fund its losses, the company has long issued shares, which you can see in the massive increase in shares outstanding over the past decade. But it's recently started taking out much more debt, increasing risk to the business. Either Plug Power must do something it has never done before and generate enough money to fund operations and repay its debt, or it will be forced to continue to dilute shareholders and add more debt. As you can see, Plug grew revenues by almost 100% last year, but the fast growth is not translating into profitability. In fact, the operating losses are increasing along with the revenue growth. This net loss and cash burn is alarming, as it shows that the business is struggling to become profitable, notwithstanding good sales numbers. Based on management's forecast, Plug Power will begin to generate positive operational cash flow in 2020. But we'll have to wait and see if this turns out to be just another broken promise. Could this time be different? Management thinks this time is different, and they have caught my attention with some good points. Essentially, management thinks now is the perfect time. Specifically, they claim the company should sustain its increased sales momentum into 2020 and beyond, thanks to increasing pressure on companies to find cost-efficient ways to reduce carbon emissions. According to Plug's CEO, demand for clean energy is stronger than ever. Large companies are hungry to expand operations with productivity and revenue-enhancing technology, but are acutely aware of the need for sustainable solutions and growth. In other words, there's a lot of pressure out there, both from regulators and consumers, on big companies to reduce their carbon footprints. There is also speculation that the Rona-fueled transition to online shopping could translate into stronger demand for the company's products going forward. Plug's CEO said he thinks that e-commerce will be stronger after the Roni ends than it was before it began. Retail internet sales of food are going to come out of this stronger than ever before. The grandmom who never bought food online before is now having deliveries dropped off at her front door. An increase in online shopping means an increase in warehousing, which should translate to an increase in demand for Plug's products. The CEO also said that Plug Power was partnering with at least 2 of its pedestal customers to deliver hydrogen fuel cell trucks. Could Amazon and Walmart be pushing Plug Power to provide green trucks in order to impress environmentally conscious consumers? Let me know what you think. Also, let me know in that comment section if you think management will be able to turn this puppy around and hit those 2024 forecast numbers, or if you think management is just blowing smoke again. My opinion. This stock has historically been a roller coaster, and I don't expect that to change anytime soon. I would not be surprised at all if we saw some huge swings upwards on the events that create hype, such as a potential merger or the landing of a new flagship client, or sales of a hydrogen truck. However, I also would not be surprised if following the hype-fueled run-ups, sentiment quickly changes bearish upon more quarters of net losses, investor dilution, and cash burn. Until the path to consistent profitability is solidified, volatility seems likely, and Plug appears to be nothing more than a high-risk, high-return spec stock. However, if fuel cells do become a profitable technology, any upcoming volatility could provide a nice entry point at very low prices. Personally, I'm happy to wait for another bearish run before I consider opening a position. It seems like there is a good chance that, true to their history, management will severely miss their guidance and disappoint shareholders at some point in the future. This could cause share prices to dip and provide a good entry point for anyone wanting in. I'd rather buy disappointment and hope for a hype or profit-fueled rebound than buy into hype and have to cross my fingers and hope that this is finally the time that management gets it right, especially given all the uncertainty surrounding profitability. Any position would be very small due to the speculative nature of this stock. At this point in time, I'm not sold on fuel cell technology, and it doesn't seem like most of the auto industry is either. Recently, almost every big player in the auto industry has announced massive initiatives to transition parts of their product lines to battery electric vehicles. Why are they not also aggressively pursuing fuel cell technology initiatives? Why aren't many other fuel cell forklift companies opening up? Probably because it's simply not a profitable business, so why would they? However, if Plug ever does prove that fuel cells are a profitable enterprise, Plug will likely face a whole new challenge, one of competition. In its annual report, the company notes that neither it nor its competitors can achieve a significant proprietary position on the basic fuel cell technologies. Although this is a bit concerning, as it makes me question whether Plug has a legit moat, it is not a deal killer, in my opinion. The design and integration of Plug's specific fuel cell system and system components, as well as its low-cost manufacturing processes, are intellectual property that can be protected. This leads to a big reason why I am a fan of the hydrogen fuel infrastructure acquisitions that Plug is planning. Not only would vertical integration into the hydrogen generation and sales business help bring down the total operating costs of its vehicles and provide a stream of recurring revenue, but it could also act as a moat against future competitors who do not have an extensive hydrogen fueling station network. At the end of the day, if fuel cell technology can reach the inflection point and become both economically attractive for customers while being profitable for producers, Plug should see serious upside. However, I'm not convinced that this will happen in the near future, so I'm happy to wait and hope for a better price to enter this stock. I think ultimately I would want a very small amount of exposure to this speculative stock, but at prices where the risk-reward makes more sense. Let me know in the comments below. Do you like Plug Power as a long-term investment opportunity? What about as a short-term swing type of trade, if you get in before management inevitably creates more hype around this stock? Oh, and as a reminder, I invite you to subscribe to this channel and would really appreciate the support if you let me know that you liked the video by clicking the thumbs up button. It really helps the channel to grow with the YouTube algorithms. Thanks you guys. I look forward to seeing you all on the next one. Best of luck. See you later.